Welcome to This Explainer. There is this massive, incredibly expensive lie in modern life that we all just kind of accept. And it's the idea that looking rich and actually being rich are the exact same thing. Today, we're really going to unpack the hidden mechanics of financial extraction, because the truth is, the financial system is absolutely not a neutral playing field. It's a meticulously engineered machine, one that rewards invisibility and heavily punishes the desire to be seen. So let's look at exactly how it operates, starting right from the car in your driveway to the bank holding your money, all the way up to the stock market. To get started, let's just take a look at the illusion we all live with every single day. Picture this. You're standing in a grocery store line, right? The person in front of you is wearing a faded t-shirt and they're driving a dented 2018 Toyota Camry. Meanwhile, another person is heading back to their leased $210,000 BMW. Now, you might feel a fleeting sense of silent pity for the Camry driver, but the math tells a wildly different story. The person in the BMW was likely up at 11 at night, frantically moving money between accounts just to make sure a tuition check clears. But that Camry driver? Even making a fraction of the income, she is quietly sitting on a net worth of $1.4 million that she literally never talks about. It just perfectly sets up the trap of visible wealth. And the quietest wealth destroyer in the country, by far, is depreciation. Let's actually look at the data here because it's brutal. A BMW 7 Series loses roughly 67% of its value in just 5 years. A Jaguar I-Pace? That loses 72%. When you really break that math down, it functions exactly like a parking meter that charges you $36 every single day just to sit in your garage. You are actively feeding a meter that drains your net worth, all while giving you this total illusion of success. So why on earth do we do it? Well, it goes back to a concept called conspicuous consumption. In a society that's entirely organized around money, status doesn't actually come from merely holding on to resources. It comes from visibly wasting them. The reputational value is literally in the waste itself. Spending money to look wealthy is a signaling system that arithmetically guarantees you stay broke. Why? Because the more expensive the signal is, the faster it decays. All right, moving to Section 1, the penalty for being broke, and how the banking system algorithmically categorizes your worth. Now, you might think the banking system is just broken when you see how it punishes the poor, but it's actually engineered to work exactly this way. Look at how the bank treats you at different tiers of wealth. The bank itself doesn't change. It just decides who you are based entirely on the number next to your name. At step 1, if you have a negative balance, you aren't a customer. You're just a risk score with shoes, a problem that needs to be punished. But hit step 2 with just $2,000 in the account, and suddenly you're viewed as profitable. The fees disappear. They start offering you credit lines. Then you hit step 3, say $25 million, and you aren't even a customer anymore. You're a partner. They literally consult on emerging markets. Keep in mind, you are the exact same person at every single tier. The sheer cruelty of this math becomes so obvious when you hit 0. Imagine you forget about a scheduled $4 coffee charge, and your account dips into the negative. Boom! That tiny $4 mistake instantly triggers a $35 penalty. The penalty for being broke is literally that you are forced to become more broke. The system mathematically ensures that those with the least end up paying the absolute most, keeping people at the bottom algorithmically trapped in this vicious cycle of extraction. And here is the reality we really have to understand. The bank isn't acting out of malice. The system doesn't have it out for you. It's just completely indifferent. But indifference at scale looks exactly like cruelty. You just exist as a data point. The institution operates flawlessly to extract fees from the most vulnerable, all while offering bespoke, waived fee services to the ultra-rich. Let's move to Section 2, the retail investor trap, and why financial markets are built for insiders to exit on outsiders. So this extraction doesn't stop at your checking account, not at all. When average earners finally manage to save enough to put their money into the market, they very often fall right into the greater fool theory. This theory states that an asset's price isn't justified by its underlying utility, but purely by the belief that someone else, a greater fool, is going to buy it from you for more money later on. If you strip away all the slick marketing narratives about digital gold or inflation hedges, Bitcoin is arguably the absolute largest real-time experiment in this theory we've ever seen. Think about it. When you put Bitcoin to the basic, fundamental tests of money, the failure is glaring. Just compare it to Visa. Bitcoin handles about 500,000 transactions a day. Visa does 65,000 transactions every single second. Plus, Bitcoin is priced entirely in US dollars, so it totally fails as a unit of account. And as a store of value, get this, just 2% of addresses control 95% of the supply. That makes it incredibly vulnerable to massive manipulation. It basically lacks any real utility outside of pure speculation. But hey, the traditional stock market operates on mechanics that are just as engineered. Take the recent SpaceX IPO, for example. The company went public at a valuation of around $1.75 trillion. That is a staggering 94 times last year's revenue. They're pricing the stock as if a flawless utopian future has already arrived, essentially pulling all the potential value forward to the launch date. Now pay super close attention to this lockup schedule. Usually, insiders are locked out of selling their shares for 180 days after an IPO, just to protect retail buyers. But SpaceX built a highly staggered release. At day 70, day 90, and day 105, 7% tranches of insider shares suddenly become eligible for sale. So that massive day one price pop you see all over the news, it's actually just a countdown clock. The higher the stock runs in those first few weeks, the faster these insider shares unlock. The brutal asymmetry of this setup is just crystal clear. On one side of the trade, you have the retail buyer, purchasing on day one, based purely on hype and headlines. But on the other side, you have the early insiders armed with these completely predictable, mathematically engineered exit windows. The IPO mechanics aren't designed to make the day one buyer rich, folks. They are perfectly, intentionally structured to provide the liquidity for insiders to exit. This brings us to Section 3, History's Original Extraction Machine, and how a 17th century spice company invented corporate monopolies. If you're sitting there thinking this kind of aggressive financial engineering is just some modern glitch in the matrix, we actually have to go way back to the 1600s. The Dutch East India Company, or the VOC, basically wrote the original blueprint for corporate monopolies. The Dutch government forced all their rival spice merchants into one massive entity, and to fund it, they literally invented the initial public offering. But to ensure those massive returns for their new investors, they didn't just compete fairly. They violently conquered the Bond Islands to secure an absolute ironclad monopoly on nutmeg. This allowed them to operate on a staggering 600% margin, delivering 40% dividends to their shareholders, all while completely and utterly disregarding human life. There's this chilling quote from the VOC's Governor General Jan Petersen Cohen that really says it all. He said, "We cannot make trade without war, nor war without trade." He orchestrated the brutal takeover of those islands specifically to guarantee those profit margins. It perfectly underscores the dark, historical root of our modern system. It's the prioritization of relentless, brutal financial efficiency and shareholder dividends above absolutely all human costs. Which leads us to our final section, Section 4, How to Opt Out and Change the Direction of Your Compounding Wealth. Okay, so we've seen how the banking system heavily penalizes you, how the markets extract value from you, and exactly where this whole machinery originated. So how do you actually escape it? The answer lies in one incredibly simple truth. Wealth is what you don't see. Your true net worth is made entirely of the money you actively chose not to convert into visible objects. The only way to win this rigged game is to literally stop playing for status. Keep your wealth out of your driveway, keep it off your wrist, and keep it hidden in your accounts where it can actually compound and grow. Mathematically speaking, this all comes down to your savings rate. If you can manage to increase your savings rate to 20%, you can cut more than a full decade off your working life. A whole decade! And the crazy part is, you don't even need to make more money to do this. You just need to make absolutely sure that when you get your next raise, you don't instantly go out and convert it into a higher car payment or a bigger mortgage. Psychologists actually have a name for this. They call it the spotlight effect. We dramatically, wildly overestimate how much anyone is actually paying attention to us. So before you go and finance that next big status symbol, really ask yourself, who are you actually buying this for? And are they even looking? The truth is, they're not.